So price distribution or distribution of price. I talk about this all the time with you guys, and this is just something that we can dig even deeper on, as just using actual price, not back testing, hindsight trading, or anything like that. Literally showing you guys the live markets and how this applies to, and how data applies to the markets in such a clean way. So people will always talk about hundreds of ways of trading, right? ICT, smart money concepts, support and resistance, lunar cycles, all that stuff, right? There's so many ways of trading, and people want to find every in which way to argue that their way is the best way or their way is the right way. There's no right or wrong way, but I would love to give you guys my representation of why statistics and data, for me, trump everything else in terms of being able to see price as clean as possible. Because if I know that there's going to be, let's say, a fair value gap, right? Like if I'm trading fair value gaps with a break of a rate on liquidity, right? That's one of the most common ways that people trade ICT, is when price raids a liquidity, right, then forms a fair value gap, and then people will take that trade off the fair value gap and go this way. Again, great way of trading. If you can make money with a way of trading, please do that. But this is why, even in scenarios like this, statistics and data are creating price to do this, to then get to an area. So if you understand that there is a single point on the chart that is driven by data for price to move to and be distributed to, and if you understand that the catalyst that causes price to then go to that area on the chart, now what we're going to dig deep into, because those other videos that I've already done, the other recordings, all that stuff, I've already created tons of content on the catalyst that causes this, why the midnight snap works with the retracement, but we haven't really touched on the distribution of getting from point A to point B. And that's what we're going over here, is why does price move the way it moves in very predictive patterns and consistent movements of price and percentages and points every single day? It's because data will never lie, because statistics are a self-fulfilling prophecy, right? If we as human beings do something statistically 60 to 70% of the time, and we find that metric over the grand scheme of 10 plus years, it's going to always be in that statistical area. That's just how math works. So if I know that in an AM session, so if I add my sessions indicator here, and I make it highlighted to show from 8 to 12 and from 12 to market close, so let's do that. And then let's turn off the midnight snap altogether. And let's just have the session, the AM and PM session highlighted. So you can see here, let me turn that on, turn that off. So it's showing New York as 8 to 12, Tokyo from 12 to, why is that not drawing? There we go. Oh, it's because it hasn't made yet, duh. Okay, so if I'm on the 1 minute time frame here, and I know, if you can see, even last Friday played perfectly with data. So if I know that on Friday, we see down here, and how did I get this data? One, I've been studying MNQ since the day I was born into the market. No, I'm joking. But I've been studying MNQ for quite some time, and I'm actually building, just like how I have Midnight Snap as like a passive way of measuring these data points, I'm actively getting an indicator built to passively show this. But right now, this is just me going back and analyzing hundreds of sessions of price and finding this statistic manually. But there's going to be a tool in the future, just like the Midnight Snap, so stay tuned for that. But if I know that on Friday we have a statistical 1.2% distribution of price. So let's add this on here. Let's take the highest point and the lowest point of Friday, and let's see where price distributed to. The highest point and low point in AM, and what do you know? 1.27. Again, we're not predicting that it's going to stop right on a dime at 1.2, but we know with a very high probability that price is going to move around this range, 1.2%. And now we use leptokurtic distributions of price, aka my indicator, these little green wolves here. We know when price is going to most likely retrace from this statistical point. So if I know that price is going to move 1.2%, distribute 1.2% in this session, and then I have leptokurtic distributions telling me when price is going to be in my favor, and then I shoot for a 25-point target because I know that price will move in any direction in structure, 25 points worth of NASDAQ, you can see there's data on data on data on data to have price move, and you're able to, with precision, see where price is going to move very, very consistently. So Friday was right in line with data. Let's take a look at Friday PM. Friday PM, 0.7%. Take the high of the Friday PM session, take the low. What do you know? 0.7, 0.81%, and it was right in line. Or no, I'm sorry, 0.7. It moved 0.81%, but 0.7 was here. And look at what happened. 0.7% right there was around the average, the statistical average. Here was the bullish leptokurtic distribution of price right there, and 25 points right there. So you can see, like, with precision, how 25 points can literally retire you, 25 points, and using data to get to that end point, to get to that decision that you're going to make on these charts. So now, going into today's market, you can see, one, we know where price is going to have the catalyst of creating structure to a single area on the chart. Two, we know where that area on the chart is, midnight open. Three, we know where the data is going to take us and when to actually practice the markets, when to practice this and put it into the charts, when to engage in price. And then the last point of where is this distribution going to end, most likely around 0.86%, around this area. Again, it's not going to be exact. It's not like, it's funny to see that price stopped almost on a dime at 0.86%. You can see right now we're digging a little bit deeper right here. But in this general area, that's where price is most likely going to distribute to. So I don't care about some fair value gap on a higher time frame. I don't care about Dixie nonsense, none of that stuff. I don't care, because the data is what's going to create all that into fruition. That's what's going to create the reaction off that fair value gap. That's what's going to create that standard deviation mean reversion. That's what's going to create that breakout of that resistance or a rebound off of the support that you're going to buy off support and short off of resistance, whatever. That's what's going to create that distribution. So that's why I love data so much, is because if we know that price will never move in a singular direction, it will only move in higher highs and higher lows and lower lower highs. If it can only move in this direction, the data is going to tell us in these movements where it's going to distribute to, right? We're going to see these distributions being met. Doesn't matter. Like, let's say this is a 4-hour time frame and they're making structure on the 4-hour. Well, every single day in these 4-hour segments, let's say this is a representation of every New York session. Every single session of New York, it's going to create structure within structure. And the structure within structure is going to be delivered from data, right? There's going to be liquidity right here somewhere that's going to start the delivery. And then the delivery in and of itself is going to have a statistic based on the day of the week that it's going to most likely run from. And then you're going to have a potential correction. Now, again, it's not going to be exact. Let's say this was the statistical day, but we kept on digging deeper, just like how you're seeing price do right here, right? We're not saying it's going to exactly stop here, but what we're saying is with a high probability, 0.86% is where you're going to start seeing the catalyst for a shift, or start seeing a pause in price for the rest of the morning, or start to see something happening instead of just a singular direction. So that's this right here. And then it may mean revert and find balance over here to continue a higher time frame structure. However you want to see that, what we're doing is we're finding these distributions and we're taking a small piece of the pie. We're saying that, hey, I'm not trying to take this entire move. I just want a piece of the pie. I want this much right here. You guys can have the rest. You market makers, you guys can take how much ever you want from the market. Me, as a professional trader focusing on what matters, I am fine only taking 25 points. Price can move 100 points, 200 points, 70 bazillion points. I'm okay taking 25 points. That's it. 25 points, 25 points, 25 points. But if I know with a statistical edge that we're going to distribute price in any given day off of any given day of the week and in a specific session of the day of the week, AM or PM, then now I know the science behind where price is going to most likely move and react from. So all we're doing here is we're just using statistics and data, and then the really cool edge that I have. Again, I'm not trying to sell you. You do not need my indicator to thrive in the markets behind some paywall, but it does help you get it a little bit better, right? All the Pack Trade Group members, we have this statistical edge, and then on top of that, we have the leptokurtic distribution of when price is going to most likely be in our favor on any side of the market. Again, this can still be wrong. We can still take losses. We took loss Friday, right, off of a 14-day win streak. They're still going to happen. Everyone experiences losses. Everyone experiences losing trades. But we have precision and accuracy from the data, and then you can use this data however you want to do it. So this little workshop today was just to go over, because we've already went over why footprints work. We've already went over why the midnight retracement works so well, and it'll always continue to work. And then now we've went over the in-between, right? We broke down the science why these footprints work. We broke down the science why these work. Now I'm breaking down the science of this distribution from point A to point B and why this distribution works so consistently. Because we know that the distribution here is where all the people that move the market are going to cause that catalyst to start creating sell pressure. And where is that? A footprint, an impulsive wick on a higher time frame. And why am I looking at the hourly time frame? Because my data tells me that I average a 48-minute hold time on all of my trades. So if I average a 48-minute hold time, I really only need to know what the hourly candlesticks are doing. I don't need to know anything else. So now I use data of my trading model to add that to the charts, and I use objective sell pressure as my catalyst to know where price is most likely going to go. And then now I know the science because I just did this workshop for you all. Now you know the science of when this catalyst happens, the distribution that it takes to get to that end goal. And then I've already did a video on why the end goal is the consistent. Now it's just data on data on data on data on data. 4 or 5 different data points, all backed by years of data and statistics. So I hope this workshop was helpful for you guys. I just wanted to do it very quick. I want to respect your time. And if you guys have any questions at all, just drop them below. Or if you're watching this live, drop them in the pack chat and we can go over them now.